Hello, welcome back to this short video. Today I'm going to have a look at a director paying themselves a small salary and dividends, and where their gross income will go up to £100,000, and then how much salary they need to pay to clear exactly the same amount. The reason why this 100k is a specific threshold is because when you earn more than £100,000, for every £2 you earn more than £100,000, you lose £1 of your personal tax-free allowance. So a lot of directors, shareholders, try and pay them up to that 100k threshold and not more than that if they can, not to lose their personal tax-free allowance. Right, so let's just go straight into it. So in this example, I'm just looking at the director who wants to pay himself a small salary and dividends, and the salary is £9,096 and paid him dividends of £90,904, which will take their gross income up to £100,000. Now, in order to achieve this, the company needs to have £130,301 turnover. As I said, the director paid himself £9,096 gross salary, so that's an expense in the business. So you take the turnover less the director's salary, gives you profit in the business, on which corporation tax needs to be paid. Now, I've just taken worst case scenario 25%. If this is a sole director shareholder business, then some of those profits will be taxed at 19% and some will be taxed at 26.5%. But I've just taken worst case scenario 25% flat rate in this calculation. So if you take the profit before tax less the corporation tax, gives you retained income in the business, and this is what you can pay out as dividends. So that's how I calculated the 90,904 plus the director's salary, gives him total 100k income for the tax year. In his personal tax returns, when he submits that, he's going to have a personal tax liability of £20,038, which gives him a net after-tax position of £79,962. At the bottom here, I've just added up the summary of the taxes. So the company will pay £30,301 corporation tax, and that's the personal tax liability, which means the total tax between the company and personal tax is £50,339. Now, let's have a look at what this will look like if you had to earn that in a salary. So in this example, you would need to earn a salary of £128,635 gross salary. That will be your PAYE tax. That will be your employee national insurance. So if you take gross salary less PAYE, less NI, employer NI, will give you a net salary of £79,962. And that's the same amount that he cleared in the first example. Now, if you look at the company's overall position, the company will also need to pay employer national insurance. So really, the company needs to do turnover of that gross salary plus the employer national insurance, which brings me to this £145,131 turnover. So just to talk you through the calculation again, that's the turnover, 145,131, less employer national insurance, that's an expense, less gross salary, gives you profit in the business of zero, then that's why there's no corporation tax in this example, but the director will clear that. If you add up all the taxes now, which is the employer national insurance, PAYE tax, employer national insurance, you will get £65,169. So actually at this level, there's a huge difference between paying a small salary and dividends compared to paying just the salary. There's a difference of 14,830. Just remember, this is going to be just for this case. You know, you've got to check all these different salary levels at different points. But it was just interesting how big the difference was exactly at this point. So it will be interesting now to see if I up that to £145,131 to see how much you will clear more. So that's exactly what I did in the second example here. Increase the turnover to that amount. Obviously, the whole calculation changes now. The profit before corporation tax is more. The corporation tax itself is more. The retained income is slightly more. Now, it's more dividends that the director can now pay out to themselves. So this one's the total gross income will be 111,122. The personal tax liability will also increase, which means in this example, the turnover increased by 14,830, but the income will only increase by 5,671 to £85,633. The reason why the increase isn't massive, I've did a calculation here just to see, you clear 38% of that, of all the extra income, you only clear 38%. And the reason is, like I said right in the beginning, it's because you lose your personal tax-free allowance. For every £2 that goes over the 100K, you lose £1 of your personal allowance. So again, where directors can just pay them up to the 100K threshold, if they can afford and live with that money, that's super good. And they save quite a bit of money, and it's definitely still better to pay a small salary and dividends up to that threshold compared to salary. And the main reason why there's such a big difference is because in a company, the calculation works very different. You have the income, less the salary, gives you profit, less corporation tax. And that retained income is what you can pay out as dividends. So, whereas in this example, if you pay salary, you get taxed on the gross salary that you pay out. So, the calculations works very differently between the two scenarios. But I hope you found that useful, and just very, very important to do these calculations if you at specific levels. So if your salary moves, it's better to do a calculation to check that you're on the right track with a small salary and dividends. Also, if you've got other income, it becomes more complicated. So you have to check these things to make sure you're on the right track. Thank you so much for listening.